Keep rolling, 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 though the streams are swollen. Keep them dogs.
The following is presented for informational and educational purposes only. This is not investment advice. Please consult your financial advisor. Thank you. Good day. It's Saturday, July 19th, 2025. And I was just going to do a quick walkthrough of some option repositioning that I made this week with the vertical spread trades. And I want to make a little bit of an educational video, something that I discovered was optimal somewhat by accident. So let's dive into those. So this week I had an open position in the Global X Uranium ETF, URA, for a long strike of 30 and a short strike of 40 vertical call spread. This was a January expiration date. So the price, as we see on the chart, let's do a quick bar replay. Let's go. Let's go back to here. Bar replay. So the entry would have been somewhere right here on the chart where I would have taken that. Let's draw. So 40. So our short leg's up here, 40. Our long leg is at 30. And we paid 2 and change, 240, somewhere in there would be what I would have paid. Maybe a little less. So my break even is going to be at expiration through $32 and somewhere like 43 cents and all. That works. Okay, so that's break even. All right, so you can see that. So let's color. This is my long position. Let's make it green. My short position, I'll make it red. And break even, I don't know, orange. Okay, so as I've discussed in prior videos, vertical call trades, really any option trade where you got long call position, any of that, profit is not a straight horizontal line like it would be if you just bought the stock. There is a time and volatility element. For the purposes of forecasting, volatility is fairly difficult to get your arms around. So I use historic volatility to kind of estimate where the price is going to be in the future at any given time. So I put in, this is a review of, I put in my trade rules for that management plan. 70% of max gain is my target, 50% stop underneath. So let's, this is not, yeah, my price override. Let's assume that I paid $2.40 for this guy. So it would calculate, this is the original position. It's calculating a target of 772 on the option trade and a stop of 120. Okay, so when I plug that into my portfolio management parameters using my painting tool, I end up with a polygon that looks like the one on your screen. So the green is going to be the profit zone. The red is the loss zone, with the stop loss being at the very bottom and the profit taking being at the very top. However, so all kinds of things can happen, right? Stock can go like this, and it can go kind of sideways out here, and this would be a profitable trade. My management plan is to close at around 21 DTE so that I don't risk losing all of my gains in the last couple of days due to volatility and whatnot. So that's just the prudent plan. Again, this trade is a delta trade. We're not trying to scrape theta, get some time premium and volatility premium. This is primarily taking advantage of our assumption that the stock is going to go in this left to right, bottom to top manner in the case of calls. So you have scenario number one, it just goes sideways. Scenario number two, we wiggle around, and we stop, and we break or stop. Okay, pretty straightforward, right? Probably just going to close that position. In this scenario, things really have changed. Looking left, it's probably time to take loss and reassess another entry position if we're going to get back in this particular stock. So what if the price goes this way, right? That's good. Change it to green. That's good, but we have to get way up to $45, $6, $7 to get our $7.70 target price. Now keep in mind that we put 240 down, so that would be what, about a 200% gain. Not so bad. Nobody ever went broke taking profit. But is there a better way to do this? And the answer is maybe. So going back to our, let's make these bigger. Going back to our call strike lines. Let's call them the call strike lines. Get rid of these scenarios. And let's go ahead and replay that guy in there. Okay, so we've entered our trade. There it goes. Boom, looking great. And it's, as you can see, if you follow my Substack, you're probably already familiar with this stock, right? So this ETF. Sorry. You may be even in it yourself. So it's taking this trajectory. So we're now at this upper limit. So once we get into, this is our short leg here. So this one's working against us. The long leg's down here. So once we approach the short leg in a vertical option trade, the short leg will start to overpower the long leg in terms of its rate of change. If that makes sense. So I've used the lemon example before. Let's stick with the lemon. At this point, you're working for Chick-fil-A, you're 17, squeezing lemons. That's your job, right? And so you don't squeeze the lemon until the last drop of juice comes out, or your boss is he's gonna have it with you. So you get another lemon, right? So at this point, there's diminishing returns and sort of the lemon squeezing way. So what can we do here? That was the question that arrived on a couple of trades in the last couple of weeks. What can I do, and what does it look like if I take an action like rolling my expiration date and or my strike prices? Let me pull back a little bit. Okay, so first of all, the first thing we need to decide right up front is, do we believe that this run is nearly complete, or does it have the energy to continue much higher? And if you follow the uranium space and follow this ETF, the answer is yes. It does have the potential, especially in the next 6 months, to continue to go higher. Let's see. The other issue is on this trade, the market's closed now, of course, but it's pricing me. This is a maximum of $10 spread here. It's pricing $7 is what it's worth. What if I could take my money? What if I could take all my profits? So I paid $2.40 and I'm at $7. So let's do that. $7, $2.40. Gotta love Excel, right? Minus. So now up. I'm now up $4.60 on a $2.40 investment. So that's pretty beefy. What would be nice? What if we could take the $4.60 off the table, put it in our pocket, and maintain the amount of levered exposure we have to the upside of the stock? That's the question. And the answer is, it appears that you can. So fast forward to, I'm not going to go down here into the option chain and show you, do all the shopping. You can figure that out for yourselves, just save the time here. But I decided essentially there was liquidity at the 40-50 level. So let's see here. Of course, rats. Turns out what I did was extremely prudent, because at the time that I made this roll trade, I believe it was Friday, my implied volatility on my long option was a bit larger than the short option. So that made it extremely enticing, or more enticing, to go ahead and move that, because in theory, we have a 31 volatility and a 35. We have a historic volatility of 41. This guy would, in theory, trend toward the historic volatility, and which means if I'm short that position, it's gonna hit my profitability. So my thought process was, if this guy is large, like 0.5, and this guy's 0.35, then let's go ahead and get long the 0.35, sell the 0.5, and hopefully the one that we short's even cheaper in terms of volatility. That's even better. But unfortunately, the market has changed, as it's prone to do. It has changed, and that tiny volatility arbitrage isn't there. That was attractive. It doesn't it's not the big decision maker. It's just something that I observed once I used my tool here to lay out the roll option. Now, by the way, this is the roll calculator. How I kind of made the decision. So we got a 30-40 up top. We've got our 40-50 on bottom. It says I'm going to get about a $7 profit for the sell, and it's going to cost me only $3.20 for the new position. So roughly, if I was in for 240, roughly I've taken almost all my profit off the table. And sometimes, depending on what you pay, you might take all your profit off the table. I had that case with Newmont earlier this month. So the next thing I'm going to look at, this is a delta trade. So let's look at how does my delta change relative to the two different positions. And again, it's not as attractive at this moment. The market's closed as it was when I made the trade. The delta of my position that I held was actually much lower. It was like 28 or 27 on a net delta. This is going to be the long and the short, the difference between the long position and the short position, long position, short position. So in other words, this is the expectation of $1 movement upwards, what I would get in return. And so I went from a lower delta to a higher delta. This tells me the delta improvement. So when I actually entered it in, my delta improvement was something like, I don't know, 0.004, something like that. So what that told me was, here's another point of view. My delta of my capital that was in there, I'm getting about in the short term, I'm getting about a 200% levered to the underlying URA. And if I just stay in the position I have, by the way, absolutely nothing wrong with staying here. This was a winner, and that if you're in this position, it's not a bad thing at all. This is just, I'm just giving you how to make it even sweeter, right? Especially if you want to take profits. So nothing wrong with staying in the position. Could have done that. But what if I take some money off the table? Do I still have the profitability and the upside? And the answer is yes. I maintain my upward delta. Now I have more leverage because I've taken capital off the table, but I haven't actually taken the potential to make money by doing the roll. That's the big what for. So if you have, say you have 10 contracts and you're right at $7,000, you put $2,400 in. So now you can take, we're taking, it's 320. we're taking $4 and we're $4,800 of profit. We're taking off the table, and we're not impairing our ability to make the next dollar at all. If as opposed to just staying into the position. So, quick little heuristic rule on trade management of these: if you get at or near your short leg, go shop the market and see what the market will give you for rolling. And that's why I built this tool, to do the comparison and kind of calculate, am I improving my delta? Am I improving my risk reward? Am I improving my my leverage? Again, I'm taking money off the table. So increasing leverage and taking money off the table actually improves my value at risk, because now the most I can lose is, if I'm 10 contracts in, is $3,200, where I could have lost 7,000 leaving it all on the table. So I know that this is actually a conservative move, even though I'm adding leverage. So that's the quantitative illustration there. So let me go ahead and just paint the new position here. Get these trend lines up. I've shaded it slightly differently. So here we are. The lower polygon's going away. Now I did not extend the duration of this trade. And now time is a little bit more urgent than it was. So if the guy decides to really go to sleep or walk sideways, it could happen. Obviously, it's not as attractive as it was down here. That's kind of true. I didn't add contracts, incidentally. I may consider adding contracts. I have the capital to do so, but I would be looking for some kind of pattern that makes that attractive. But even if I hit my stop here, in the conventional trading manner, this is what I've essentially done, is put in a trail stop. So, if you want to think of it that way, as a trail stop, or grab another lemon, not too difficult. And in the same manner, we have a $50 ceiling. In the same manner, we'll consider what we want to do if we continue vertically. This has been a pretty big run, but if we were to do that, it's tricky. URA has a lot of liquidity at year end, and it may not be so much, for the June contract or the March. I don't know if there's a March or April contract there. So we'll just have to shop the market and see if that, more money, more problems, right? If we have that problem of taking profits, we'll assess it there. But I think as a general heuristic rule, if your trade does exceptionally well and you're thinking, boy, I wish I just had bought the leap, then this is a good option here in your management. All right, well, that's it for now. If you're not already subscribed to my Substack, please do. I appreciate you doing that. There's a premium membership, but primarily I'm looking to provide content to friends, family, other investors, mostly for free. I'm only really charging for stuff that requires a fair amount of testing and work on my end. I am working on a few projects, including portfolio management reporting tool powered by Y-Sheets. There's a Y-Sheets affiliate link here, by the way. It'll save you $30 under the toolbox. And within that, I will have, an option reporting feature that will look at the contracts, and it will work through the gains and losses and unrealized gains, realized gains, so that, if you're an option trader, you can track what's going on. It's a little bit messy to do it manually. So that's in the works. Anyway, that's it for now. Thanks, guys.